David, let's start with the fact that no change to rates, which was expected, but there was a cut to the growth outlook. Was that surprising?
No, actually, it pretty much lines up with what we were thinking going into the meeting. The Canadian economy has been beset by a number of shocks. You have not only the wildfires impact in northern Alberta, which will take a big bite out of the second quarter, but there's also some deceleration in some of the trade data that we had going into that release. And in addition, we have some of the concerns over Brexit risk and what that might do to business investment over the second half of the year. So collectively, I think the bank is still taking a reasonably prudent approach in revising down their expectation for growth this year and even into next year as well.
So explain to me, they revised down their growth outlook. They didn't cut rates, but the Loonie moved up immediately, at least afterwards. Why did we see that move?
Yeah, I think maybe the market was a little bit too eager in thinking that the bank would be even more concerned about the outlook and might even start to change their language in terms of where maybe the balance of risk was to the future outlook for inflation, or that the current level of policy would be appropriate. So maybe there's just that expectation that the market was running a little bit too far ahead of itself.
Let me ask you, they did go to great pains actually to emphasize the fact that they've got a heated housing market in Toronto and Vancouver. How does that impact your outlook in terms of what the Bank of Canada will do and their thoughts around that?
Yeah, it's a really open debate at this stage what monetary policy can do to try to slow aspects of the Canadian housing market, because at the end of the day, the bank has one policy tool, and that's largely trying to motivate economic growth through the exchange rate, but also has an indirect impact on the housing market. So if the Bank of Canada needs to keep rates very accommodative to support the wider economy, that will maybe add additional fuel in terms of debt for the household sector. So it's a challenge for them to walk down that road, because if they were to try to think of exclusively trying to slow the housing market, it would also do a lot of damage to the wider economy.
Let me ask you, last question, double-barreled question. Where do you see the Loonie going from here? And also, what do you think the Bank of Canada is going to be watching as they move ahead?
Yeah, I think on the second question first, perhaps, I think the Bank of Canada will be very focused on the external backdrop, and a big part of their growth thesis is to see the export side of Canada's economy improve, and that does really necessitate a stronger global backdrop, so the U.S. in particular, but as we would also look to see some of the follow-through from the concerns over Brexit, and if businesses become a little bit more cautious, that would be net negative. So how does that all figure in with the currency? On our front, I think we do see a little bit more weakness in the Canadian dollar. Part of that will be a resurgence in the U.S. dollar. I think maybe the market was too aggressive in pushing out any chance that the Federal Reserve might hike interest rates over the next year or so. Not that we expect a dramatic move on that front, but that's enough in our view to at least keep the currency subdued here in Canada.
David, thank you.
You're very welcome.